All right. Well, we can get started and we'll let people continue to filter on in. Um, so everyone, thanks for joining us. I'm Jordan Fry from the Prudent Plastic Surgeon, as you know, and I'm joined by Kenton Allen, who is one of the founders of Doc2Doc Lending, which I think is a really cool company and one of these really unique sort of founded by doctors for doctors companies. So he's been gracious enough to lend us some of his time in talking about what they do and sort of how they're empowering doctors through the programs that they offer to improve their financial well-being, which I think is really awesome. So I'll sort of let you take it from here, Ken, and then we'll have some time afterwards for Q&A and kind of delve into things a little bit more.
Sure. Well, first, thanks for letting me be part of the discussion tonight. And like I said, I've benefited from a lot of the topics and articles that you've put out there through the Prudent Plastic Surgeon. So I'm humbled by the invitation to be part of the conversation, part of the community, and and thank you for the kind words for introduction. And part of I think the purpose of tonight is to share a little bit about Doc2Doc Lending, but also, kind of be available to any questions or insight that might help with respect to, how to kind of look at debt in certain parts of finances as well, be that being what we do, and having spoken with 4,000 doctors over the past 4 years who are considering that. And so to answer your question, Doc2Doc Lending. So Doc2Doc Lending is a company. We offer our flagship product is a personal loan exclusively to doctors, and it was founded on the principle that doctors as a niche population are more creditworthy than typical banks tend to give us credit for. And my experience and what kind of led to the founding of Doc2Doc was early on in my career. I went to Dartmouth for medical and business school and was married there. We had two kids just before I graduated. We had our second daughter, and so I moved to Boston for residency with my wife, who was a nurse, supported me through medical school. Our two young kids. We were in a high cost of living area, and I had about $250,000 worth of student loan debt at that time. My salary as a resident was $54,000, and the long and short of it is I couldn't support our family on my salary if we wanted to keep progressing in all of our personal and professional goals that my wife and I had set. And I looked at ways to supplement my salary, and was kind of surprised and disheartened to see that I was viewed as a really high risk borrower because of that debt to income ratio. And this is despite what seemed like being on a really promising career trajectory. We job offers pretty much from the time we started residency. And that was kind of lost in the underwriting process and seeing me as a risky borrower. So for me, I ended up using credit cards and in my mid 30s asking family for support, which was also humbling. And so circle back a few years later, myself and my co-founder, Zwade Marshall, who was also a resident in Boston with me, that's how we met, had a similar experience. He needed access to capital for different reasons. And as we spoke to our peers, we found that our situation of needing access to money was not unique. And in fact, a lot of our peers at various levels of their career, for different reasons, needed access to capital to keep things on track. So we founded Doc2Doc in 2017 on that premise, and we underwrite our loans differently. We don't use FICO score as part of our underwriting. We pull out components that are in FICO score that we feel are relevant to our population, and then use other doctor-specific metrics, kind of predictors of successful careers in medicine, to ultimately determine eligibility and what the interest rate should be. And it's allowed us to offer, what the vast majority of time are the most competitive options, with the strongest value proposition being in the training years in the first 10, 15 years in your career. And so we kind of have had a great story of where we've come, and I'd be happy to share it if you're interested, Jordan. But the kind of long and short of what we do is to provide a source of capital for doctors when they need it for personal reasons, professional reasons, whatever they need, that they can get it and be viewed in what we think is a more appropriate risk profile.
Yeah, and I think that's really cool. I had a similar experience in that when I was going through my training, and especially I was in New York City. My wife was getting her PhD. I was a resident, so we weren't making very much money, and we had two kids. I think we calculated at one point like 70% or more of our income was going towards rent and childcare, and we just didn't have a lot left over. And there were certain things that we used credit card debt for that were just necessary expenses. Things like I had to do exam fees for my written boards and things like that, where I just took it out as credit card debt. It was 28% or more APR. I didn't even necessarily recognize at the time, which was ridiculous, but that's just because of my lack of financial awareness at that time. But just kind of insane. And it's like you said, when you think about it, we are good credit-worthy people, and we don't want to take out debt irresponsibly, but there are times, especially in our younger career, where we do need to take it on. And so you're providing a service and something that looks past kind of the superficial nature of us as borrowers to help other doctors out, which I think is really cool. So could you speak? I want to talk about how this could be used on the professional side of things, and we'll kind of get to that. But on the personal side, what are people mostly, or what are doctors, young doctors, coming and saying to you, hey, these are our pain points, this is what we're using this for? Like, what are some of the most common reasons?
Yeah, so we kind of divide the market into three categories. So we have fourth year medical students, which eligibility into our program starts at a successful match day. So basically, once someone is matched in fourth year medical school, that's when they can qualify, and that's the first kind of group, is fourth year medical students. And then the second group is in training physicians. So these are people in their residencies or fellowships. And then the third group is the kind of post-training in practice segment. And for folks who are coming out of fourth year medical school, the use case is almost always transition costs, and student loans aren't eligible for those costs. And so going and kind of tapping into student loans isn't usually an option for most people. And so we help with moving from medical school to particularly high cost of living areas, where to move from Boston to San Francisco it can cost $25,000 just to kind of get from point A to point B and get yourself on your feet. People in residency, there's kind of I think an awareness that happens towards, as residency is starting to end, for financial wellness, and this is kind of a positive trend that I would see in our profession, and shoring up someone's financial profile tends to become a priority, particularly towards the end. And so we help by refinancing a lot of that high interest credit card revolving debt into an installment debt. And there's a couple ways that helps people. One is when there are some major loans on the horizon. So these are things like mortgages. If you're gonna start a practice or buy into a private practice, kind of business financing, being able to go into those negotiations with the best credit profile can save thousands over years by shaving off even fractions of a point on an interest rate. And so, when you look at what determines credit score after repayment history, the second one is credit utilization, and that's the the percentage of credit extended to you that is being utilized. And so if you have, 3 credit cards of $10,000 each, for example, you have $30,000 of credit, and the percentage of that you're utilizing is a really big component. And so kind of refinancing out of that high interest debt not only helps that metric, but it helps kind of get out of that high interest debt over time. So as people are starting to pay a lot of attention to their credit profile in residency, we do a lot of credit card refinance. And then there's people who are in situations like I was in residency, which are just kind of life, be it growing a family or family planning, and unexpected healthcare costs. These are all things that just kind of happen, and oftentimes the stressful component to them is financial. And so our goal is to kind of smooth the path that we walked by taking some of that financial burden, by allowing people access to money at fair rates. And then the last case, the in-practice physician, this is kind of the most varied use case. And we see things all across the board, why people for various reasons need some supplemental funding. I think probably most relevant to this community is helping to fund entrepreneurial activities or kind of bridge gap financing. So I would clarify what I mean by that. There's in the entrepreneurial activities, I think there's a growing interest within our physician community for activities that provide supplemental income. And there can be some startup cost to that, right? Where business lending isn't exactly gonna get you there. And so we support a lot of those activities. And then what I mean by gap financing is when there is business financing available, and probably most notably is the SBA program, the Small Business Administration loans that are offered through the federal government for practice startup, practice expansion, or really entrepreneurial startup activity in general. You have to put a certain amount of your own capital into that before they extend you the loan. Typically it's 10%. And so if you qualify for an SBA loan but don't have that portion that you want to put in, we help people in situations like that. We act as an alternative to hard money lending and real estate investing for a lot of folks. So there's multiple use cases in that group, but the overarching principle is we want to take away the financial stress of achieving those personal and professional goals.
I'll unmute myself first. I always thought, specifically too, you mentioned it like an alternative to hard money lending in real estate investing. I think that's a really cool concept too. To me, it almost seems like a cheat code a little bit for physicians that are able to use this, because there's that kind of concept in real estate investing of BRRRR investing, where you buy, rehab, rent, refinance, repeat. But you're usually buying properties that don't qualify for a traditional loan. So you're looking for alternative sources, which are often hard money lending, these kind of loans with really super high interest rates that you basically take to buy the property and rehab it. And then you're looking to refinance and get that money back and pay it back as soon as possible because the rates are so high. And this provides a really low interest rate alternative to that, which doctors have available to us, and other people don't. So that's a really cool thing, especially for physicians that are interested in real estate investing, and that's becoming a lot more of us, myself included, that do a decent amount of that. So I think that's a really interesting use. And then you brought up with the loans kind of for practices. Do you see a lot of doctors looking for help in starting their practice, like overcoming those startup costs? And it's a tough thing because it's one of the, I forget exactly what year was the first year that more doctors were employed than in private practice for the first time, and I'm an employed physician. Is that something you're seeing more of, or?
Yeah, the I think I've seen the same data sets that the trend nationally is for more and more folks to be employed. Um, but there certainly, anecdotally, in just kind of speaking with people who've reached out to us, there are still plenty of people who are targeting the flexibility of private practice, and valuing that over some of the benefits of employed practice. But it can be tough to make the jump from an employed position, to building your own practice, or even joining an existing private practice, and having to put money up to buy into those private practices. So the the both of those certainly are happening. I can say that it seems to be more challenging to start your own practice, both from a financing perspective, and just kind of the lift of getting a new business off the ground. There's really only a handful of lenders that will work with startup practices. Those tend to be the big, the big national banks. Bank of America Practice Solution, and Wells Fargo has an arm that does it. There's some kind of regional specialty specific lenders that work in that space as well. But a lot of people are using the SBA program. And the downside of the SBA program is that, it can be kind of long and arduous, to get from the point of deciding you want to jump to having the application approved, and getting access to those funds. So, what we offer is a personal consumer loan. Um, we do have some very strong commercial lending, kind of guidance that we provide, but our flagship product is a personal loan. And so, again, the practice financing is out there, and it's happening. There's, for the people who do it, spoken to a lot of people who are really happy about it, that they've done it, but it's certainly a big lift.
Yeah, very cool. And can you just briefly sort of go over what's the process when someone reaches out and says, "Hey, I am looking for this loan," whether it's to pay off high interest debt, to cover some necessary expense, or to begin some either side or main business interest. What's the process like?
Yeah. So our application page is just a online 3-page form. So it really takes a couple minutes, to fill out. And most of the time, at the completion of that, there's a conditional approval, which will kind of show you the interest rate and the amount that you'd approve from. Certainly within 12 hours. There are some times where we would need to verify identity, for example, before that immediate approval pops up. So at the longest, it would be 12 hours. From that time, if anyone wanted to move forward with that conditional approval, typically the funds are in the account within 5 to 7 business days. So it's a pretty quick process. We've designed our application so that there's only a soft credit pull, meaning that there's the hard credit pulls when you apply for loans. The more of those that show up on your credit report, the bigger the impact can be on your credit score. And so by using a soft credit pull, there's no negative impact to applying, from start to finish. the application process, to answer your question directly, requires generally 1 or 2 documents that's done electronically to verify you are who you say you are. And that tends to be the one piece in addition to that application form. So it's a pretty quick process. We offer to speak with anybody who applies. We have a physician experience team of doctors who work for Doc2Doc, and we'll reach out and speak with any applicant if they want to say, this is what I'm trying to do. What do you think is your product a good solution? And we kind of talk through the use cases. And there's instances in which our loan product isn't the best option out there, and we're very transparent about when there's there's better financing options. But we want this to be truly a kind of community building, mission driven company. And so we do that through individual conversations with people.
Awesome. And John has put a question in the chat box. I'll invite anyone, any questions, put them in the chat box, or feel free to raise your hand or just chime in. So John says, what are the range of interest rates, and is the interest deductible on these personal loans?
Thanks for the question, John, first of all. So our interest rates run 8.99 to 15.99. We have a 0.25% auto pay discount. Now, when you hear 8.99 to 15.99, I think a lot of people are saying, well, that sounds like a really high rate, especially compared to my my mortgage, my auto loan or my student loans. And the reason that there's a difference there is because, again, this is a personal consumer loan, meaning that it's completely unsecure. There's no asset that backs it. It's really, we're just underwriting the ability of an individual to pay that back. And so because the unsecured versus secured type of lending, that's why the interest rates on consumer lending tend to be higher. Now, if you were to, and I encourage everybody to kind of do their own diligence, don't just take my word for it, but I think if you look out there into what the options are, we're consistently very competitive, and in most cases the most competitive for the community. So, but I mentioned that because I said earlier that there are instances in which a personal loan isn't the best path to achieve what you're trying to achieve, and we're very clear about that. There's particularly in business lending, there's ways to get a securitized loan that will ultimately get you to a lower interest rate. And so yep, our rates are 8.99 to 15.99. They did increase twice through last year through the kind of inflationary environment that we're in, but we expect them to stay where they are for the foreseeable future.
And then is the interest deductible? I assume is what he's.
Yeah, no. So, and I apologize. My screen has frozen a couple times here since we started. So, I think it's frozen just now. But the interest on personal loans really aren't tax deductible. We ask the purpose of the loan when on our intake form, but it really doesn't matter to us in the underwriting process. And so it's not tax deductible the same way some of those other securitized products could be. And the reason for that is because it's really not it's not explicitly for a business expense.
Okay. And then Nalini sent in a question that says, do you have options for other doctors to be the lender for your firm?
Yeah, so good question. Our capital structure has evolved over time. When we first started, we were taking investments from doctors. We kind of modeled our startup with that of SoFi. Kind of, we did what they did for student loan lending. And at that point, we were taking investment and using the majority of that investment to lend out. At this point, we have a more mature capital structure where we're not fundraising to make loans. We have a debt facility from which we pull from that allows us to make loans and use that money more efficiently. And so the direct answer is there's a small fraction of every dollar that we lend that that is partially funded by our prior fundraises. Of the investment rounds that we've had, about 90% of those investments have been from the physician community. So our equity is through physician investors, and we do have a formal seed round that will be opening in the next couple weeks, and again is open to the physician community. But at this point, our fundraising efforts are not used directly to fund loans.
Got it. All right. And if anyone else has any more questions, make sure just send them right on in the chat box, or feel free to shout them out anytime. Can you talk a little bit about the process of like starting Doc2Doc Lending? So when you guys had this idea, and then sort of, obviously it's going to be a long story, but sort of take us through how that fully materialized into Doc2Doc Lending, because I think there's a lot of interest there as, you know, like you said, physicians are becoming more entrepreneurial, or maybe feeling more comfortable expressing that entrepreneurial spirit. So how did that kind of work out?
Sure. You know, so I mentioned that we started Doc2Doc in 2017, and when we started it, we incorporated the company, but didn't actually make a loan for 2 years, and it took us that 2 years really to feel comfortable about jumping. And when I say jumping, for us, the big moment was accepting investment dollars, because the people who were investing were our friends, our colleagues, our mentors, all the people who believed in the concept. And from 2017 to 2019, it was, we self-funded the company. We kind of put our own money to use, and talked to as many people as we could. So for 2 years, we held focus groups and went to medical conferences where we knew there were going to be a lot of doctors, and reserve spaces where we could bring in as many people who would be willing to speak with us and hear about their experiences. And it was overwhelming. Two things: that our experience wasn't unique, that it was shared even more prevalently than we thought. And the second was that the resounding feedback was, I get it. This would have been really valuable to me. And I want to be part of it. And so we had those conversations, wanting to focus group people to see if there was a market, and this was a good business idea. And we came out of it with a whole cohort of people who believed it so strongly that they wanted to invest in it. And so that's kind of what gave us the confidence to jump. For me, I still identify as a doctor, and always have. I have a clinical practice, and that still makes up the majority of my time. And Doc2Doc is now a team of about 30 people who run the daily operations. And myself and my co-founder, as physicians, recognize that as a financial technology company, there's expertise that we don't have. So we have a really accomplished team of professionals that are expert in the areas where we are not. And one of the things I take the most pride in is the team of people that we built, who believe in the mission, but also have a really deep knowledge and experience in this space.
Awesome. And another question from Nalini: what is the typical time of the loan to pay back? And could you share a few experiences if a loan is not repaid, what protocol is in place? So first, typical time for the loan to be paid back.
Yeah. So all of our loans are underwritten over 5 years, and they're all fixed rate products. And so the advantage of 5 years in personal lending, that's on a little bit on the longer side. And so the benefit of that is that from a cash flow perspective, it can be a friendly payment, meaning that the monthly payments, if underwritten over a longer period of time, are going to be less. And so we want it to be less likely to be stressful from a monthly cash flow perspective. Now, tied into that is we have no prepayment. So if someone wants to borrow a loan for a house flip, they can have what is a relatively lower monthly payment. But if they want to pay it off over 3 months or 6 months, there's no downside to doing that. There's no prepayment penalty. So that's the kind of term, is 5 years. The protocol for non-payment or delinquencies, first of all, is we have really robust hardship programs. And so our goal here is to prevent anybody from not being able to make a payment. And we recognize that circumstances change. So we can almost always offer something that's affordable for whatever the hardship is, and prevent having to report to the credit bureau, because as a company that's in a really tightly regulated space, we are required to report any 30, 60, 90-day late payments to the credit bureau. It's not an option that we have. We have to under the regulations. But if someone enters into one of our hardship programs, they can make fractional payments, something that's affordable, and we can sidestep having to say that a loan is delinquent. But the typical protocol is, again, we have to report at every 30, 60, 90-day delinquent payment we have to our credit bureau. We have a kind of a third-party servicer that will also kind of help make contact where we can't, but all the initial outreach is done by that same team of doctors, because our goal is to, like I said, shore up people's financial profile, not be a source to help it go the other direction.
And then Enrico just asked a question: what's the least and maximum amount of loan you can lend?
Yeah, so we lend $5,000 to $100,000 for in-practice doctors, which I think is probably a lot of folks in this community. For people who are in training or in medical school, it's $5,000 to $25,000. Now we do have some kind of nuances to that. We have a couple special programs, for example, for visa holders. The medical profession has a high representation of international medical graduates who are on visas, and for them, access to capital is even more difficult. And so we have programs for J1, H1B, and O1 visa holders as well. Those programs are slightly different, so that the caps are a little bit different on the borrowing amounts, but kind of in general, for the majority of folks we see coming through, it's up to $100,000 for in practicing doctors, and then $25,000 for in training.
And then Edward's asking, are there any programs or criteria for international medical docs like that are practicing in Canada, not in the US? So not like a visa holder in the US, but in
Yeah,
Canada.
yeah, great question. So not as of right now. So you do have to be practicing in the United States right now as part of the eligibility criteria that we do have. But the reverse, international medical graduates who are practicing in the United States on a visa, again, there are eligibility programs for there.
Okay. And then Rico's asking, how long does the application process take, kind of on average? We touched a little bit on the application process, but maybe you can kind of go over that
Yeah.
a little more from Rico.
Sure. Yeah. No. Happy to. Thanks for the question, Enrico. The application itself is a 3-page online application. Takes 3 to 5 minutes. The majority will give you a pre-approval right at the end of that process. Um, uh, you'll be offered the chance to speak with one of the doctors on our team, and I'd say a lot of people take that up. We usually make those phone calls happen within 12 to 24 hours. Um, Not everybody wants to speak with us, so you certainly don't have to. And then from that point, from the time of the application being completed to the time that the funds arrive in your account, on average is 5 to 7 business days. And the variability in there generally is how quickly the applicant uploads the 1 or 2 documents we need to basically verify you are who you say you are and you are in fact a doctor. So we try never to be the rate limiting step, but on average it's about 5 to 7 business days from application complete to money in the account. And I apologize for my video freezing here again.
Oh, that's okay. And then a really good question here from Nalini again. Do you have to have a business pro forma before applying for the loan if you're doing a loan for a commercial purpose? And I think I think I know the answer to this, and I think it's a big advantage of again, kind of Doc2Doc, but I'll let you take it, obviously.
Yeah. So again, this is a personal loan, consumer loan, meaning that we ask what you use it for, but it doesn't matter to us really what you're using it for. We're underwriting the individual and not the business. So we don't need any business information if you want this to be used to help supplement the business. Now, in the case where a personal loan is being used for business activities, typically what we'll talk about in that conversation is whether there's alternatives for your business use for a loan product that would offer you a lower interest rate. And I'll give you an example. So say you're you're in an orthopedic practice that needs a new C-arm, and uh, a, a a consumer loan wouldn't be the best product for that use case, because there are loan products specifically for equipment that are secure, that use that piece of equipment as collateral for the loan. It's called a secured loan. And because if you stop paying that loan, the bank that offered you the money to buy that C-arm could then repossess the C-arm and recuperate some of their losses. A personal loan, there's nothing to recuperate after. We're just saying that we believe that you're, as a doctor, are creditworthy, and we'll offer you the most competitive rate. But it's still an unsecured loan, so the interest rate on an unsecured loan is almost always going to be higher than interest rate on a secured loan. Long answer to a simple question, which is no, we don't need any business pro forma or business financial data. Just some personal data.
Yeah, and I think that's definitely a nice advantage to again what you're offering. Let's see. What about this is Edward again. What about international medical docs in the US working as allied healthcare currently, not yet working as an MD? Are they considered
Sure.
these loans?
Yeah, again, thanks for the question. So as of now, we loan exclusively to doctors, and we define doctors as physicians and dentists. And so the eligibility point, if you're an allied health professional now, but are going to become a doctor, the point at which you're eligible for our product would be at a successful match day. So once you have matched, that's kind of the earliest that that will be eligible. Now, in the future, we realize that the career arc of a physician, there are some other medical professions that have very similar paths. I'm an anesthesiologist, so I work with nurse anesthetists a lot, and it's very the nurse anesthetist experience is very similar in a lot of ways, and so at some point that may become part of what we offer, but for the time being, it's doctors that we lend to.
All right, very good. Well, I'll see if anyone else has any more questions. If not, we'll begin to wrap up. And I just want to thank you, Kenton, again for your time. And it's really cool, again, to talk to a physician who identified a need amongst other physicians and went about and created a very successful company in implementing those changes. And so thank you for everything you do. And I think it's really great. You guys are always very education first, which is awesome. So thanks for taking the time to educate us. And if people are looking to get in touch with you to learn more, or if they are looking for one of these loans, what's the best and easiest way?
Yeah. Well, first of all, thanks for having me. It's really, like I said, it was my pleasure. We have a shared landing page through together, and so anyone who's interested in our product, I'd encourage you to apply. Like I said, there's no downside to applying in terms of your credit profile. It's only a soft pull. It's a pretty quick application, and at the end of that, like I said, there's always the option to speak with one of us, and it's meant to be a collegial conversation. Anybody anybody just want to kind of speak or speak about any other topic, I'd be happy to as well. And Jordan certainly has my contact information too. So don't hesitate to reach out to Jordan, and we can either all get on the phone or you can make an introduction that way. And I'd love to continue the conversation with anybody.
All right, awesome. Well, thanks so much, Kenton. Thanks for everyone who joined us, and we'll talk later.
All right, thanks so much.